The repo market has been all over financial headlines this week, and if you're wondering what the heck that even means, don't worry, I've got y'all covered. So let's talk about what it is and why it actually matters for investors. Repo stands for repurchase agreement, and I think of the repo market as a sort of pawn shop for banks. Stay with me here. So when you need quick cash, you can go to a pawn shop and hand over something valuable like a watch or a ring in exchange for cash or a cash loan. Later, you can come back to the pawn shop, repay the loan, and get your item back. That's exactly what banks and dealers do in the repo market. Banks need cash to operate, and at the end of every day, banks are required to have a certain level of cash reserve sitting either in their own vaults or at a Fed bank. If a bank is short on cash or unable to meet their reserve requirement, one option they have is to pawn some of their safe assets to another bank in exchange for a short-term cash loan. Typically, it's just an overnight loan, and usually the safe assets are treasuries, mortgage-backed securities, etc. When banks pawn their securities for cash, they promise to come back the next day and repurchase those securities at a slightly higher price, and that tiny markup basically represents the interest on the loan. A lot of times, these overnight loans happen between banks. However, the Fed is also able to participate in the repo market through its standing repo facility. This facility is basically a Fed-owned pawn shop where banks can hand over their securities for short-term cash loans. Now, when repo activity and rates suddenly spike, and we have a lot of securities being pawned, it can mean that cash is getting harder for banks to come by. It tells investors the banking system is feeling tight, banks need money fast, and they're willing to pay up for it. On Friday and Monday, through its repo facility, the Fed injected billions of dollars into the banking system, and this caught a lot of attention because people are worried right now about liquidity. Reasons for this fear include a lot of factors. So firstly, bank reserves have fallen to their lowest levels in 4 years. Secondly, we've had quantitative tightening happening since 2022, which has pulled more money out of the banking system. And then third, to top it all off, the government shutdown means that money is still going into the government right now, but not very much is coming out, which also shrinks the money supply. That's why when this happened last week, people really noticed. Now, yesterday, the repo market returned to its relatively normal status quo operations, but this dynamic is definitely something that everyone should keep in mind, especially as the government shutdown continues. So, in short, the repo market is Wall Street's pawn shop, a place to swap treasuries for quick cash.